Joining me right now in a Fox Business exclusive is the president of the Federal Reserve Bank of San Francisco. John Williams is here. John, it's great to see you.
Great to see you.
Thank you so much for joining us this morning. So let me get your reaction right away on this GDP number just hitting the tape up 2.1%. What does that tell you?
I mean, that's been pretty consistent with the data we've been seeing for the last year or two, about 2% growth. It's consistent with the economy coming into 2017 with good momentum. So I think it's a consistent picture that we've been seeing for some time, and that's encouraging.
Where is the growth in the economy right now?
Well, it's the consumer. I mean, the U.S. economy is always driven by the consumer, but with, wealth at very high levels in terms of the stock market, housing market having rebounded, with job growth being good, the consumer is the big driver of the economy, and I think that will continue through this year and next.
And of course, the consumer spending 2/3 of economic growth, so that makes sense. But for a long time, several years, we've been waiting for the business segment to really break out. And the business segment, in terms of businesses sitting on cash, unwilling to hire new workers or invest in R&D, what are you seeing there? That's the area that we need to see change, right?
Well, we're seeing a lot more optimism in the surveys of businesses and households, and that's a positive sign. We're seeing some other indicators of improved sentiment. Still, the investment data, I want to wait to see the hard data. And you're right, investment data has been a little weaker than expected, and I want to see some actual improvement in that. And it's an area to definitely focus on, along with the continued improvement in the housing sector, which still isn't quite back to full strength.
Now, the Federal Reserve raised interest rates just a week and a half ago. Tell me what was behind that decision and what you're expecting for 2017 in the way of interest rate hikes.
Sure. I think the context of the rate hike was really that we've got unemployment down to 4.7%. Inflation's moving back to our 2% goal. So we're getting pretty close to our two goals of maximum employment and price stability. At the same time, interest rates are really low. So monetary policy is really adding a lot of stimulus. So we need to gradually take away some of that stimulus, get interest rates gradually back to normal levels. And so doing that rate hike in March, following on our rate hike in December, makes sense to me. It's a way for us to move monetary policy to a more neutral stance as the economy continues to improve.
Do you worry that now we are finally feeling, after a lot of sort of years of stagnant growth, we're finally feeling a little bit of a breakout with the consumer doing well, as you noted, with, sentiment certainly rising, the stock market doing better, that as you raise interest rates, that's just going to whack it, just as soon as we just started getting traction?
Well, first of all, 2 points I'd make. The goal here is to keep the economy on a healthy pace, so not to undermine the economic expansion. In fact, I would say the goal is to keep this expansion going as long as we can, but that means we have to balance the risks. We don't want the economy to run too hot and get ahead of itself, and that can create imbalances and risks for the economy. But you're right, we also don't want it to slow down. We want to keep it on the track it's on, and that's why we're going to go gradually. We're going to go, I think, removing policy accommodation appropriately over the next few years. And I think we're going to try to get that balance. And as you know, getting that perfect soft landing, that's hard to do, but that's what we're aiming for.
So how do you do that then? I mean, when you say gradual, does that mean it's going to be quarter points all the way?
Well, I have to say what I always say. It's going to be data dependent. We're going to be driven by how the economy's doing, what the data look like. But right now, I think this view that my colleagues have expressed in our various projections, that 3 rate hikes overall for this year seems to be about right. I think there's some upside risk to the economy, not risk, but upside potential to the economy. Maybe we'll need to have maybe 4 rate hikes this year, depending on the economic data, depending on how inflation and employment do. I think that will continue next year as we move more to a normal interest rate. That's kind of what I think of as in terms of gradual.
So for the longest time, it was all about the Fed. I mean, for several years, that was the stimulus that this economy was getting because you've kept interest rates at rock bottom levels. Now we're seeing a different story come out of Washington. We'll finally get some fiscal policy in the way of tax reform, I think. We'll get rollback of regulations, I think. And do you think that is going to move the needle on economic growth? What are you expecting the impact of new policies out of Washington to be?
Well, I agree 100% with your basic premise is that monetary policy has been the only game in town, if you will, for some time, and we need to have that handoff because monetary policy can only do so much. We've achieved, I think we're coming close to achieving our goals. So we do need fiscal policy, federal, state, and local policies to be taking over in terms of promoting growth and economic prosperity. Now, right now, my view is I'm pretty uncertain about what fiscal policy will be. Like many people, we're going to have to wait and see what happens with tax tax reform, tax cuts, regulatory reform. Right now, I don't really need to know what happens because I think our monetary policy decisions make sense just based on the data we've seen. But going later this year, that's going to be one of the factors we'll be watching carefully. Personally, my view is we'll probably get some fiscal stimulus. I'm not sure it's going to be a big fiscal stimulus. So that's right now I'm trying to be right in the middle there in terms of my views. I expect there to be some stimulus next year, maybe 2019, but I'm not really counting on a big stimulus.
Now, you will be voting in terms of the Federal Reserve and what to do next at the FOMC with interest rates next year.
Right.
What will be most important in terms of dictating how you vote when to raise rates next?
Well, it's going to be, again, driven by our goals, which is maximum employment and the price stability. So it's really going to be seen how fast can this economy grow and keep without creating inflationary pressures or other imbalances, and really trying to get that normalization process, both in terms of interest rates, but also our balance sheet, which I think that normalization will probably start maybe later this year or next year, getting that process underway to bring monetary policy back to a more normal setting at the same time as keeping this economy growing at a healthy pace, keeping a strong labor market, and keeping inflation low and stable.
So would you like to see that balance sheet begin to unravel sometime this year? Would you like to get that balance sheet down? Obviously, it's going to take time.
Right.
How large are we talking about the balance sheet now? $3 trillion?
Well, it's over $4 trillion now.
Yeah, $4 trillion.
And we're talking about getting, it'll take many years, as you said, to do that. I think it does make sense to start that process gradually in the next year or so, depending on how the economy is doing. We've said that we would start normalizing the balance sheet once the federal funds rate normalization was well underway. I think that test will probably be met later this year, or late this year. So I think that's a natural part of getting monetary policy back to normal, positioned for whatever happens in the future.